Welcome to this comprehensive masterclass on the accounting of goodwill. In the world of partnership accounting, the retirement of a partner is a pivotal event that requires precise financial adjustments. Master these entries step by step. Goodwill represents the reputation and future profit potential that a firm has built over time. It is a vital, intangible asset. When a partner retires, they leave behind their share of this potential value. The continuing partners must compensate them. Our journey today covers three specific scenarios. First, we'll handle case 1, where goodwill is not yet recorded in the books. Next, case 2 deals with complex cases where an existing book balance must be written off completely before revaluation. Finally, case 3 introduces the super profit method, an essential and more advanced valuation technique for your exams. Consistency is the key to perfect accounting. Always follow this golden sequence. Start by calculating the new gaining ratios. Then determine the firm's total goodwill value. Check for existing book balances. And finally pass the capital entries. Let's start with case 1. In this scenario, goodwill is absent from the books. We have a partnership with 4 individuals. Surender, Ramesh, Naresh and Mohan are partners. When Naresh decides to retire, we calculate the remaining partners' gains. The original ratio was 2 to 1 to 2 to 1. Upon Naresh's retirement, the others agree to share the profits equally. By subtracting the old shares, we find that Ramesh and Mohan each gain 1/6, giving us a perfect 1 to 1 ratio. Now let's look at the valuation. The firm's total goodwill is professionally determined to be 72,000. Since Naresh's old share was 1/3 of the firm, a specific portion of that goodwill value is 24,000. Here is the critical journal entry. We debit the gaining partners Ramesh and Mohan for 12,000 each. Finally, we credit Naresh's capital account for the full 24,000 to record his fair compensation. Moving to case 2. Here goodwill already appears in the books at 50,000, but revaluation shows 45,000. Always remember the rule. The existing book balance must be written off completely before we can adjust for the new valuation. We distribute the 50,000 write-off among all partners. X is debited for 10, Y for 15, and Z for 25,000. This important step clears the outdated goodwill value from our financial statements before the new adjustment. Next, the gain analysis. After X retires, the new ratio is equal. Y moves from 3/10 up to 5/10. Interestingly, Z's share stays at 5/10, meaning Y alone is the gaining partner who will bear the cost. Now we adjust the new valuation of 45,000. X's fair share is calculated at exactly 9,000. We debit Y's capital account for 9,000 and credit X's account to settle the goodwill compensation. A final example, case 3, introduces the super profit method. Arjun, Beam and Nakul are our partners. With Beam retiring, we are provided with a predetermined gaining ratio of 1 to 4 for the continuing partners. Step 1 is calculating the average profit based on the last 3 years, which gives us 55,000. We then compare this with the normal profit expected in the industry, which is given as 30,000. By subtracting the normal profit from our average, we find a super profit of 25,000 rupees. Valuing the firm's goodwill at 2 years purchase gives us a total of 50,000 for the partnership. Therefore, Beam's retiring share of 5/25 comes to exactly 10,000. This is his settlement. Case 3 also includes an existing goodwill balance of 75,000 to be written off in the old ratio. Once that's done, we settle Beam's share by debiting Arjun for 2,000 and Nakul for 8,000. The final step is distributing the first post-retirement profit of 1 lakh among the continuing partners. Based on their new 3:2 ratio, Arjun is credited with 60,000 and Nakul with 40,000. To summarize, always begin by calculating your ratios and clear out any old book goodwill in the old ratio. Then, adjust the new valuation through the gaining partners. This sequence ensures perfect financial accuracy. Thank you for participating in today's masterclass. I'm your instructor Praveen Jain. Practice these entries. I look forward to seeing you in our next lesson. Keep studying, stay focused, and you will master accounting.